Welcome back. Our next panel, which will focus on delivering a capital markets union. It'll be moderated by Professor Tenreyro from the London School of Economics, and she'll be joined by a very distinguished panel. Professor?
Thank you very much, Faria. I'm very pleased to be here moderating this session. We have four distinguished panelists from your far right to left. Paul de Grauwe, professor at the London School of Economics. Jim Esposito, co-head of the Global Financing Group at Goldman Sachs.
I feel like a player coach now that I sat in your seat and now I'm on the panel.
Jonathan Faull, Director General of Financial Stability, Financial Services and Capital Markets Union at the European Commission. And last but not least, Philippe Ithurbide, Global Head of Research, Analysis and Strategy at Amundi. So let me start by asking Jonathan to outline the European Commission's objectives for a capital markets union.
Well, we've heard a lot about that already today. I mean, our immediate objective is to have a debate. And that's why we've issued a green paper and various accompanying documents, securitization, for example. We realize that there is a need, and I think that has been clearly demonstrated by what was said earlier here, to look again at capital markets in Europe and how they operate. It is true to say, as somebody said earlier, weren't we supposed to have done this in about 1959? It's been in the treaties as long as we've had treaties. That, of course, is a little unfair because we've done quite a lot. Capital movements are freer than they were in 1960, 1970, 1980, 1990, 2000 even. But there's still a lot more to be done. And the recent crisis has focused attention on just what we are missing by not having continental capital markets. I nearly said a continental capital market, at least a set of continental capital markets working across our 28 countries together. Why do we think this is necessary? Obviously, to improve access to financing. We've heard abundantly today about the dangers of over-reliance on bank finance. We've heard also about the importance of diversification, and that's another important objective. And finally, just making capital markets work better and more efficiently across Europe. What do we need to do first? What do we need to talk about and do later? What sort of instruments are necessary? Is this simply a matter of enforcing or tweaking or amending laws already there? Is it how much new legislation may or may not be necessary? How much can we do? We looked at that this morning as well. Sorry, not this morning, this afternoon. How much can we do by what we call country-specific recommendations, spreading good practices, seeing what works, holding them up as examples, because there are good examples. Capital markets do work in good ways in various parts of Europe, in various circumstances, and we can take those examples and spread them more widely. So it's a variety of different objectives, differentiated in time. There are indeed, we hope, low-hanging fruit where we can get something going fast, and Lord knows we need growth and jobs fast in the European economy, and there are longer-term projects. We've given ourselves, Lord Hill has a 5-year term in which to do this, but we want to get moving fast.
Thank you. So let's turn to the steps or actions needed. And let me start with Jim, asking Jim, does everything in the Capital Markets Union in Europe need fixing as it is? Or are there areas of the capital markets that are actually working well? And which ones are those, and what can we learn from that?
Sure. I think we need to be mindful not to throw the baby out with the bathwater around what's working and not working in the European capital markets. I would cite 3 important and large areas of the capital markets that are working incredibly well here in Europe. The first is, if you're a large cap investment grade rated European company, you have no issue. You have unencumbered access to credit markets right now. European investment grade companies enjoy the exact same access that their US peers would enjoy in terms of accessing credit markets. The second, and I think this is critical in Europe, and it came about with really no regulatory change, the high-yield bond market in Europe has grown by leaps and bounds. It's grown at something like a 30% compound annual growth rate since the financial crisis. And so by having a steady stream of supply, the buy side's invested a lot in building out credit teams that are able to do analysis on new companies that are coming to market in Europe. We're not going to get to the other side as banks pull back in Europe if we don't have a deep and liquid high-yield bond market. That's starting to happen here. A decade ago, the European high-yield market was dominated by cable issuers. It was pretty much only a cable sector market, and supply was fickle. The investor mentality was also very fickle. The third area that I would highlight, and this statistic actually surprises me, if you look at IPO volumes last year, the difference between the Europe and the US, and you can think about many IPOs getting done by growth companies, IPO volumes last year in Europe actually outpaced US IPO volumes. So large cap investment grade issuers, no issues. High yield bond market growing by leaps and bounds. Growth companies having access to taking themselves public via the IPO market. I actually feel pretty good about what's going on in Europe.
Great. Jonathan, do investors have the information they need, including investment options, or are there informational barriers that impair or restrict cross-border flows of savings?
No, there are barriers, there are gaps. And if you look at some of the figures, actually, they're quite startling. 75% of owner-managed companies do not have a credit score. That makes investment in them complicated. And therefore, and again, that's another good example of where actually one of our countries, France as it happens, has something useful that others can learn from. The French have a very good set of historical data about SMEs and their credit rating. So that is useful. On the other hand, we find, it seems paradoxical, but actually it's not, that a lot of SMEs tell us, you are overburdening us with information requirements in the prospectuses directive, for example. So you're impeding our access to stock exchanges because it's so complicated. So we have a balance to strike between the information which is necessary for investors to make an informed judgment and the burden on what is inevitably, by definition, a rather small operation in generating all these data. But we can do that. We have ideas for that, but at the moment we are consulting and we look forward to all of your contributions.
Thank you. Philippe, do we need to look at the way Europeans save and how those savings are invested, including pensions?
We have to, definitely, because as the panelists previously said, Europe is not short of savings, definitely. But Europe is short of long-term savings, long-term investors. When we want to find long-term investors in Europe, we have to place products. We have to pay attention to Asia, North America, etc. In Europe, it's not that easy. The second question about the savings is the question about whether the savings is used is being used more productively. This is the question. Today, if you look at savings in Europe, the bulk of savings is on the real estate. For example, in France, 2/3 of the financial assets and financial wealth is on real estate. Second, savings stays within the domestic countries, within the banks. With the banks, deposits. Europe, we have 3 times bigger deposits than in the United States. And as I said, the bulk of savings is within the real estate. And we have a lot of obstacles, in fact. The first one is historical. The second one is cultural. There is a lack of education. What is risk compared to return? The third one is about education, as I said. The fourth is about language. And last but not least, legal and regulation. In Europe, we have created some kind of schizophrenia. If I were Prime Minister of Spain, I would have my finance minister would be absolutely happy to have the banks buying Spanish bonus. But if I were the Minister of Economics, I would be completely depressed because the bulk of money is going into the financing the debt, which is good in one hand, but nothing going to the economy. So we have to change these kind of obstacles and particularly regulation in order to stop financial repression. Somewhere, sometimes, we will have to revert it because it's absolutely counterproductive.
Thank you. Jim, what's the best way to mobilize savers? Is it through new platforms, such as a new mini bond platform in Italy, or is through increasing the range of products in which investors can invest?
Yeah, I don't think there's a simple answer to your question. I don't think I could point to a single thing that will really unlock the savings. I think it's probably about doing a bunch of little things differently and doing a bunch of little things well. I would highlight a couple of things, however. One is streamlining and harmonizing documentation. It's very hard for either a European investor or an international investor to get up to speed on 27 or 28 different insolvency or bankruptcy codes, right? It's very hard when there's different requirements around disclosure and for an investor to understand that. I highlighted in the earlier panel the need to potentially consider relaxing some of the constraints around the European retail investor. I would support some consideration and discussion around what should be a permissible product for retail to invest in. I find it somewhat odd that a retail investor in Europe is allowed to invest in a below investment grade rated high yield bond, but not in a below investment grade rated loan. The loan product, there's nothing wrong with it. It's a floating rate product. It's a good product. And so we can look at those areas to try to really unlock some of that savings. And then you mentioned mini bond platforms. We haven't discussed in great detail peer-to-peer lenders, but I think all of these things will play a part in the future of unlocking some of the savings. Right now, peer-to-peer electronic platforms in Europe are really specific to individual countries. They're not really able to play a role in pan-European lending. I think we should look at changing that and discussing what it takes to change that. Mini bond platforms, private placement discussions, I think are all going to be a part of the solution of unlocking some of the savings.
Thank you. Jonathan, reading through the Commission's Green Paper circulated last week, there are various initiatives, going back to what Jim was saying, trying to help this transition from private to public markets. And one of them is the pan-European private placement market, as well as changes to the prospectus directive. Do you think they can have a meaningful impact, and what are the risks or problems that they might bring along?
Yes, I think they can. And again, we see that they work in some of our countries pretty well. The French, the Germans have fairly successful private placement markets. Others don't. We need to understand why. And we need to look at how we can replicate what works best and avoid what doesn't work so well. And then we'll have to look at what instruments may be necessary to achieve that. So at the moment, we've seen the problem. We've looked around Europe and seen what works and where it works. We've seen what happens in other countries, United States in particular, where private placement is 3 times the volume in Europe. Why? Why is it like that? What are we missing? And how can we address the problem? So yes, I think that is something that rightly deserves our attention, and it's something that we would like to get moving on quickly. So let's collect all the information we can about how people see it in practice. The same for the prospectus directive. As you all know, we've amended this several times before. We think we get the balance right, and then we don't. We're addressing all sorts of different interests every time we do it. It's well known to be a difficult exercise. It's a good time to do it again. And this time, let's try to be a little better in getting the balance right than we have in the past. You need information in a prospectus, obviously, but you don't want to overburden those who have to provide it. So if people tell us, and so far they have, but we look forward to more information, if people tell us that this is a real obstacle, particularly for smaller companies in tapping equity markets, okay, there are certainly ways of dealing with it.
Thank you. We've heard a lot about securitization in Europe in the previous sessions and as a way to enhance funding for SMEs. Jim, what do we need to really get kick-started with securitization in Europe? And is there investors' appetite for asset-backed securities?
Look, I'm not sure we need major regulatory or policy change to get securitization markets jump-started. I'll go back to the example that I gave about the European high-yield bond market. I wouldn't underestimate the importance of a consistent source of supply. And so the buy side, large investors are not going to staff up. They're not going to focus on a product unless they're guaranteed that it's worth their while to build out a team to really focus on a new product. Part of the problem in securitization in Europe is the supply has been fickle at best. And so investors are willing to devote more energy and effort towards it, but they're not convinced yet that there's going to be a consistent amount of supply. And so Hugh mentioned earlier a chicken and egg discussion. I think securitization does fall into that characterization as well. Now look, are there areas where we could equally streamline documentation standards, harmonize documentation standards around securitization? There is, but for me, the single biggest issue is we haven't yet had a steady stream of supply. If we can develop that, I think the market will get its legs underneath it.
Thank you. Philippe, would you like to add anything to that?
Yeah, about the ABS. ABS is a fantastic market, but of course, since the crisis, this market was killed due to the default rate in the United States, 20% around versus less than 2% in Europe. So there's very bad reputation. And the question about the ABS at the moment, it's probably the timing is not excellent in the sense that the banks are reluctant to sell the loans they have. And of course, for a market to be efficient, you need liquidity, transparency, blah, blah, blah. Plus, you need supply and demand. You have a lot of people being able to structure this kind of product. We have a lot of investors. As you probably know, Amundi is one of the few asset managers being in charge with a mandate with the ECB on the ABS. We are fans of this product, but there's no new loans from the banks in the peripheral countries, and the banks are reluctant to sell their loans. So it's very difficult to reactivate this market without this segment.
Yeah, it goes back to my QE point from the earlier panel. I think QE and all the central bank intervention has helped avoid a violent round of deleveraging, but now's the time in Europe to get on to this managed round of deleveraging. European banks right now have no incentives to sell off loans, have no incentives to package loans up and securitize them. So there are probably some minor adjustments we would make around the edges, but I think a lot of it's the lack of supply, the liquidity that's available in markets, and banks, to be quite blunt, not feeling the pressure that they need to bring their balance sheets down today. They know 5 years from now they're going to be a lot smaller than they are today, but they're going to wait to the 11th hour until they adjust the size of their balance sheets.
Thank you. So what measures could incentivize institutional investors to raise and invest in larger amounts, including SMEs, startups, long-term projects? Jim and Philippe.
There are plenty of prerequisites, but one is essential, is access to data. Today, you mentioned the credit score of the companies. Who knows the company? The banks, not necessarily the asset managers or the investors. And as long as we don't have this kind of database giving the access to information, it's very complex. Of course, for the CIO, for the portfolio managers, for the regulator, and for the risk management department as well. So what we do need at the moment is to build, to break some difference between the countries, where there was some debate about the insolvency laws of the companies. But the most important today is probably to have access to some data. Because since the crisis, again, the risk department is much more, I would say, present, active in investment. And as long as we don't have data, it's very complex to invest in. Because we know the structure in ABS, but we don't necessarily know all the components of the structure, particularly for SMEs.
Yeah, just two small points to add on. One is, again, recognizing that technology can play a role in the capital markets going forward, and a bank like Goldman Sachs might not be involved in that at all. So I do think technology is a fantastic way to connect buyers and sellers. And for the SME issue that potentially plagues Europe, I have to believe technology is a way to unlock some of the savings. And so if I was a policymaker, probably a dangerous thought, but if I were, I would spend a lot of attention looking at ways that technology could potentially unlock the savings and direct investment towards SMEs that would be a big area of focus of mine. Second, going back to securitization, one of the reasons why securitization is important as a financing technique, it helps free up balance sheet capacity for banks, right? It's a de-risking exercise, but more importantly, it frees up capacity for banks. I'm not suggesting that banks won't play a big role going forward in SME lending, but if balance sheets are clogged up, if balance sheets don't have the capacity to continue to do local lending, and lending's always going to be local around the globe, but specifically here in Europe. So securitizing assets will free up the capacity and make lending available to SMEs.
New lending, you mean?
Yeah, new lending.
Jonathan, in this search for more non-bank funding, won't the capital market union risk increasing the shadow banking sector and unregulated markets, putting financial stability at risk?
Well, I mean, the first thing to say is that a great deal has been done for financial stability in the last 5-6 years. In Europe, in each of our countries, internationally. That is the new platform, the new basis, and some of that work continues. 100% stability is not what we're looking for. You don't get growth without risk, and you have to be extremely precise in protecting the vulnerable against risk for which they cannot be held responsible, while keeping risk flowing through the economy. So we think we've got the basis right. We think we are capable, but again, subject to everything that everybody's going to tell us, to move forward, having learned lessons from what we've experienced in the last few years. We will remain alert and vigilant. Others will too. Shadow banking, it's an unfortunate word. By the way, the FSB is trying to bury it, having no doubt created it, and likes to talk about market-based finance. Now, shadow sounds dodgy. It's a bit like dark pools. There must be something sinister going on. Shadow banking has a perfectly legitimate, valid, important role to play in the financing of our economies. So my answer to the question is remain vigilant. Do not promise anybody 100% stability, because you don't get that in life. And you build on what has been achieved going forward, and you try to learn the lessons of the mistakes of the past, and use the new platform, and in Europe, use the enormous scale and scope of a 28, even 31, if you include our friends in the rest of the European Economic Area, country single market.
Thank you. Is there a need for regulatory change, Philippe? Do you think we need a change, for example, in the capital framework for investors? What's your view on this?
The question is, if we want to promote SMEs financing, if we want to promote equities, venture capital, private placement, which makes sense, because if you look at the size for Europe compared to the United States, the size is between 1 to 3, 1 to 5. So if we want to do that, and there's a huge potential, of course we have to change the regulation. It's a pity to see that the biggest asset manager, insurance company in Europe has around 5% equities in its portfolio. It's a pity. It depends on what we want. If we really want to activate the economy, growth, innovation, we have to favor startup SMEs. If we want to encourage growth, innovation, investment, we have to do it. And as a consequence, we have to revert somewhere sometime the regulation, the taxation savings. You know, France, for example, is taxing savings. It's probably one of the few countries doing that. Okay, perfect. We love taxes, not as a payer. Okay, the French love taxes, but what we do it at the opposite way. So we exclude investment incentive to equities, venture capital, etc., which is dramatic. So we have to change tax policy in financial instruments, and we have to change regulation in order to help to give support to the big and small and mid-sized companies. Definitely, we have to.
If I could just add to that, I would just highlight, and some of the speakers have made this point today, that every regulatory action has a corresponding reaction by the markets. And I highlighted that banks running with more capital and more liquidity is a positive. Banks are much more secure, they're much more stable than they've been over the past 50 years, so I couldn't be more supportive of that. However, banks holding the level of capital that they're holding today means they're changing the complexity and what they hold on their balance sheets. So if I were looking for things that keep me up at night, risks in the market that maybe we're growing complacent around, I would highlight secondary market liquidity for corporate bonds, both high yield bonds, investment grade bonds, and even emerging market corporates. New issue volumes are running at all-time highs in credit markets, yet if you track the aggregate holdings of banks of corporate bonds, banks serving their traditional role as a market maker and a liquidity provider for corporate bonds, corporate bond holdings in aggregate in the banking system is running close to a decade low right now. And you can actually track, the Federal Reserve publishes this data of aggregate corporate bond holdings. Banks aren't playing their traditional role of being a market maker in corporate bonds. Why? Because the ROE of that business isn't sufficient. It's changed now that banks are holding more regulatory capital. And I don't know how you unlock that, but I would just suggest that there's some real issues if and when the interest rate cycle changes, if and when liquidity gets removed from the markets. We're issuing bond volumes at record highs, and we're not providing the liquidity that we traditionally have. And that's just setting itself up for something that deserves a lot of attention. And again, there's no easy answers to any of this, but holding more capital and more liquidity has changed the secondary market dynamic for corporate bonds, and we're just going to have to see how that plays out in the future.
Thank you. And let me now turn to the last question and ask Paul, starting by Paul. I would like to hear everybody's view on this. The pooling of risk through securitization, as well as many other measures aimed towards this capital market union, will certainly help in diversifying firm-level risk. And this will increase risk-taking by firms and hopefully lead to more investment, which is the ultimate goal here. However, there is a risk. Aren't we risking higher exposure to aggregate or systemic risk? Should we be concerned about it? How should we react within the Capital Markets Union?
Okay, thank you very much. Yeah, I think we have discussed most of the time the benefits of Capital Markets Union, but we spent very little time on discussing the risks of a Capital Markets Union. And the way I would like to introduce it is as follows. Financial capitalism is a wonderful human invention, right? It allows savings to be channeled to the best investment projects, increasing material welfare, and in fact, it's the only system that can do that in an efficient way. But it's also an unstable system, right? That we have learned from history. It's highly unstable. And we have to think about this, what we are creating then in Europe. And the risk I see then are the following. Let me just focus on two. One is that when large economic shocks occur, then capital market integration has all the potential of increasing, amplifying that shock. And let me again go back to what happened in the monetary union. When we started the monetary union, the immediate effect of the monetary union was in fact to integrate the interbank market, right? And the money market. It was an immediate effect. And it led to large-scale capital movements from the north, basically the north of Europe to the periphery, leading to booms, bubbles in all these places, and then a crash, right? And we did all this like blind people, right? Because everybody was saying, well, policymakers were saying at least, you don't need a regulatory environment to deal with this. This will all be okay, right? We heard the same thing today, right? I do think that capital market integration has this potential when you go all the way of unleashing these large capital movements that have the potential, like so often in history, of leading to pockets of booms and busts and then crashes, and there is no institutional environment to take care of this. A second twist that I see has to do with something that has been going on very recently with the discussion about Brexit, right? It's clear that the monetary union, the Eurozone, may not be a permanent thing, right? We have been discussing the possibility of one country being kicked out, right? Which means that it may not be permanent, which creates a domination risk, a de-domination risk, and which be a huge obstacle for individual agents and institutions to diversify. Because if there is a denomination, you are knocked off, right? So these are risks that we have to take into account. Another way I would like to put it is as follows. In normal periods, in normal circumstances, capital market integration is a wonderful mechanism, right? It does all the things we have been talking about. In addition, it's an insurance mechanism. When you have an asymmetric shocks, like economists say, it allows, in fact, to stabilize the system, right? One country is hit badly, another well. Yeah, but I didn't have any time to talk before. Give me some time when I add it all up. Okay, I'm almost finished. So in normal times, it works wonderfully. In times where there is a lack of trust, capital markets and capital market integration is a huge source of instability. It will lead to upheaval when people don't trust the system. And as a result, it will put a lot of pressure on fiscal institutions to deal with the instability, right? We have fiscal, we have governments that whose duty it is to take care of these instabilities that can be unleashed in times of uncertainty. And so here I am to say that, well, it's half-baked. The capital market union without things like what Charles was mentioning, some regulatory and supervisory institutions is very dangerous to do. Capital market union without a fiscal union is a very dangerous thing to do because it may unleash this kind of instability and there is nothing to take care of this. So I'm saying, let's not hurry, right?
Jim,
and I hear from the German secretary that, in fact, it's the intention of the Germans not to hurry with capital market union. And my advice would be to follow what the German secretary has been telling us.
Thanks, Paul. Jim, would you like to add to that?
I'd love to.
Quickly.
Yeah. Look, I just say life is about a choice of the optimal alternative. And so if we don't believe in capital markets union to support growth in Europe, I suppose we believe we should leave large concentrated risks on the books of national champion European banks. To me, that system strikes me as incredibly unstable, unfair to the taxpayer who will ultimately pick up the bill in some sort of too big to fail regime. So I view capital markets union as the best alternative for risk taking and the best alternative to get the European economy growing again. I'm not saying it's not without challenges. I wouldn't suggest there doesn't need to be regulatory oversight. There absolutely does. But to argue against it would mean you want risk to be concentrated on the books of banks, and the retail savers, the taxpayer in every jurisdiction in Europe is ultimately going to pick up that bill. And that, to me, seems like a bad idea. And so we just got to be mindful. We can be critical. It may not be perfect, but I would argue it's the best of the various alternatives.
Jonathan.
Well, it's not as if it's all or nothing. I know, I'll be very honest, I know there are people out there who will reply, no doubt, to the consultation saying, you must have a supervisor. And I know that the politics of that will make it very difficult to take that issue up if people are minded to do so. But it's not as if there is no supervision. It's not as if ESMA doesn't exist. We have a platform. You may think it's not good enough, that it needs reinforcing. I don't know whether that's a minority view or a majority view. But there is oversight, there is supervision, there is regulation. It is coordinated by the European Securities Markets Authority. And insofar as banks are involved, by the European Banking Authority with the powers that it has. So we don't start from nothing. I know the temptation is to look at what happened in banking as an analogy and say, you started the euro and you did the monetary union without the economic union, then you started regulation without a supervisor, and luckily you found an article in the treaty so you could give the European Central Bank responsibility for the single supervisory mechanism, but you only did that in a crisis. I don't think, it's an easy conclusion, I don't think this is a case where it's only in a crisis that hard decisions are taken. I think we have an opportunity in the consultation process to think about these things, to look at how securities markets, capital markets more generally, are regulated and supervised in our countries. And it's only if, as a matter of objective evidence, people can show me, at least, speaking personally, that there is really a problem that needs to be addressed, that I think it's worth taking up what will definitely be a difficult political issue. Second reaction, if I may, to Professor de Grauwe, it's true that people talk about Grexit. We have freedom of expression. People talk about lots of things. The institutions of the European Union do not talk about Grexit.
But many
Philippe,
banks are doing it today by retrenching, so they don't believe you.
Well, because we are forced to be very careful, because of course it's a risk scenario where even the probability is very low. If it occurs, it is dramatic. So we have to take it into account. Doesn't mean that we share the view. It's a risk management purpose. That's it. I want to come back to the capital market union, of course, because it's the topic of the conference. It's already a reality, in fact. We already have a genuine capital markets union between biggest companies, the most sophisticated banks, the most sophisticated asset managers. The question is about the SMEs again. And of course, we cannot reduce capital market union to access of SMEs to financing. But it's very important because of a couple of reasons. First, SMEs, it's 70 million people employed. It's 2/3 of employment in Europe. It's 85% of net job creation in the past decade. And it's 2/3 of the added value in Europe. So we have to pay attention to this because, of course, if the banks are not reactive enough to give late credit, which is questionable in some countries. In some countries, banking credit didn't went back since the crisis. Anyway, if we cannot reduce to SME financing, but if we consider that one of the key purposes of the capital union is to facilitate the growth of these companies, it's a very, very good idea. It's not a revolution. It's not a big bang. It's not a sprint. It's probably a marathon. We are not in a rush. But it's a very, very good idea for the SMEs. Represent innovation, investment, and jobs, and growth at the end.
Thank you. So let's use the last few minutes to take questions from the audience.
Hi, Neil Williamson from Aberdeen Asset Management. I just wondered what your view was in terms of demand for product versus supply. And what I'm getting there is, is how much the population within Europe is demanding the right products and how much it's correctly incentivized by politicians to want the right products. We talked about there's too much debt. An awful lot of investment in Europe is at the retail level is just done into bank deposits. Do you get the sense that politicians really understand that and that tax incentive, that basically it's about the culture in Europe to get more capital flowing into equity and risk rather than the safety of pure bank deposits?
Well, as was said earlier, there are cultural issues here. We're not Americans. We are much more like each other, by the way, fellow British compatriots, than we sometimes think, we Europeans. And as my boss likes to say, he's a plumber, not an architect in this context. And there are indeed issues on the demand side. I mean, the plumbing, you can mess around under the kitchen sink, but if somebody doesn't turn the tap on upstairs, the water won't flow. And part of the problem is lack of demand, and we heard the German State Secretary talk about structural reforms, and that's all part of that. Plus, indeed, the question you raise is an interesting one. What is the appetite of the individual European investor, or indeed simply saver, for some of the things that we're cooking up for her? and I wouldn't presume to answer that question, and there are 500 million Europeans, and they're very different in some respects in the way they approach these things. But what we do know, and it comes back to all the things we were saying earlier, is you can see what happens in some of our countries. You can see what happens in some foreign countries, and you have to come to the conclusion that we are missing opportunities. There are things which work and some people are not doing, and they have a problem which doing it would help solve. That, I think, is the basic starting point for this whole exercise. And of course, it was in the treaties from the very beginning. The founding, they were fathers, I won't be politically correct, of the European Union understood that you need free movement of capital. It turned out to be difficult to achieve totally. It's about time we did it.
I would just add, I think we got to be careful not to be too harder on ourselves in Europe. The market has evolved, it has changed, and I think it's important just to bear in mind where the European retail investor came from. Retail investors in Europe grew up buying high-yielding government bonds. It wasn't that long ago where you could buy an Italian or a Spanish bond yielding 10 or 15%. There was no need to develop credit skills in Europe because the bond market, the government bond market, offered a lot of alternative and offered real yield in your portfolio. Fast forward that movie and look where we are now. I mentioned earlier the high-yield bond market has grown at a 30% compound annual growth rate since the financial crisis. So savings is evolving. It is moving to riskier asset classes. It's not going to happen overnight. I think you're right to raise the cultural point. It's going to take not just years, decades, maybe longer to change it. But as we sort of unlock the pipe and unclog the pipe, I think that's starting to happen. But we got to be careful how we measure that because we're not going to notice visible signs. But I think when you look back over a longer time series, you'll see real change.
Thank you. We have a question there first. And
Jim, you've sort of mentioned the retail aspects of demand and what might be done there. I think from an institutional investor's perspective, I think two things that particularly concern me about the securitization proposition. One is that how do you square off the liquidity aspects, which is what you've just made a very, very good point of mentioning, Jim, with demand. I mean, how are you going to get demand flowing to the institutions when they can't sort of sell on or monetize, particularly within risk portfolios? And the second aspect is corollary and possibly amplifies or is amplified by the liquidity problem, is that institutions holding securitized bonds mark them to market, regardless of the nature of the book that you're backing using these assets. What is the incentive for us as institutions to buy a securitized SME product as opposed to just lending direct to the company, where we sort of, you don't have a mark-to-market regime there. What you're doing is marking a fair value, which is a whole different ballgame.
Yeah, look, so I think there's a lot there in your question. I'd say a couple things. First, direct lending to SMEs, not only would I not be opposed to it, I think there's many places where it's a good idea. It's just a question of the size of that lending opportunity. Is it worth your while to make a $5 million investment instead of a 25 million euro investment? I don't know where the cutoff would be for your institution or others, but the idea of securitization and pooling of assets, I think, will allow more SMEs to access credit, but it doesn't have to come at the expense of direct lending. In regards to your question of mark-to-market and lack of liquidity in secondary markets, I'm not going to suggest I have any great solutions. I think it's a real challenged area right now in the unsecured corporate bond market, but equally in the secured bond markets. There's not enough liquidity out there given the ample new issue conditions we have and given the ample liquidity provisions that we have. So again, I worry a lot about it. I don't have a great solution. I'd like to think technology should play a bigger role. connecting buyers and sellers of corporate bonds, connecting buyers and sellers of securitized assets. That hasn't happened yet. I'm really surprised that we haven't seen an electronic trading platform take off. You know, some of the challenges is no one's been willing to embrace a single platform. So I think that's part of the issue. But frankly, I'm very surprised we haven't seen more electronic trading of corporate and securitized assets. But my guess is that will come in the years to follow.
Thank you. We have no time left, so let me just thank our panelists. We've heard many practical steps to actually implement a capital markets union, as well as the potential risks that it can bring along. So surely the European Commission will take the comments on board. And thanks, everyone, and let me join me in thanking the speakers.
So we at the London School of Economics and the Systemic Risk Center are delighted to have had the opportunity to work with Goldman Sachs on putting on this, what I think is a very interesting event on the Capital Markets Union. We do need the CMU because of the systemic risk that arises from the old form of financing the banks, and too much of ensuring that systemic risk is borne by the SME sector indirectly. We do need to augment bank financing by the new and direct channels between savers and investors and firms. To deliver, the European authorities do need to embrace disruptive technologies and remove the many impediments to the unified European financing system. One cannot regulate the market into existence, but we can regulate the market out of existence, as we too often do now. Today's speakers have discussed those topics from every possible direction, and I hope you all walk away much enlightened. I certainly have learned quite a bit today. And this was the first step, and the Systemic Risk Center, I'm sure Goldman Sachs as well, will be spending much time in the future fleshing out the science behind the Capital Markets Union. Before I leave, I'm delighted to thank the magnificent team at the SRC and LSE for all the hard work in creating the event. Thank you very much, Horatio, Catherine, and Anne, and thank you very much also to the Goldman Sachs team. Thank you.
So I appreciate that I'm the only thing standing between all of you and a glass of wine outside, so I've learned from experience not to say too much, but I just have two quick remarks. The first is a little bit echoing what you've just heard, to thank those involved in the preparation of this from the Goldman Sachs side, particularly the government affairs team at Goldman. Obviously to thank the ministers for coming and all of those who have participated in the panels. And of course all of you for attending today's event, which I hope has proved stimulating and interesting and worthwhile. The second thing I'd like to say is just echoing my remarks at the beginning. We have styled this event as a dialogue. It's a dialogue that I think has been initiated today, but it's a dialogue that I don't think has been completed today. We heard from Director General Faull that he's launched a consultation last week. That's a consultation that goes on through some time, and the dialogue and consultation hopefully will meld in some respects. So certainly from the Goldman side, as has already been said by John, that this is something that we hope to continue with, and we hope to invite you back to another event in the not too distant future to take stock and hopefully make further progress.